I got to ask you a question, man.
Yeah.
Do any of your buyers like paying MI, or do they even know what MI is?
No, none of my buyers like paying mortgage insurance.
No. And for you people that are listening that not exactly sure what mortgage insurance, let's define it real quick, because if you listen to my show, I hate mortgage insurance.
Yep.
It's basically a necessary evil in order to sometimes buy a house, and I preach against mortgage insurance. And mortgage insurance is a insurance policy that you're paying for in case you default. So you're paying for an insurance policy on behalf of a lender in case you default. Mortgage insurance is required when you don't have 20% down to put down on your house. And this is a big area of confusion for consumers, because a lot of consumers still think they need 20% just to buy a house. Mm-hmm. And that's just not true. You can do 100% financing, get away with as little as 3% down, sometimes as little as 1.5% down. There's tons of options. But when you do that, it comes with mortgage insurance. And I always preach against that. Or, hey, let's find the lowest possible cost, the lowest possible way to deal with mortgage insurance. And when you go with an FHA loan, it is what it is. When you go with a conventional loan, you have options. You can buy out of it. You can do what's called a single premium, so you pay a much smaller percentage up front.
Okay.
It does increase your closing costs. But when you look at your payment's lower because you don't have monthly MI involved in it.
Yeah.
And when you look at it over the course of the next 3, 4, 5 years, you're going to save a ton of money. But then there's also times where you want to pay mortgage insurance. If you've got a buyer who thinks they can't buy because they got to have 20% down, they're going to continue to rent. They're going to miss out on the property appreciation, the whole 9 yards. And what renters don't realize is they're paying a mortgage. Whether it's theirs or somebody else's, they're paying a mortgage. So if you go out there and you buy a house and you don't have 20% down, let's say you only have 3%. Sometimes maybe you don't even have that. You have 1% or 0. Mm-hmm. The point being, if you don't get in the market and buy a house, and the numbers that we like to use, like a $250,000 purchase, and in 5 years, that property is going to be worth $50,000 more based on our current appreciation rates and even some of the national historic rates. Mm-hmm. That's a comfortable appreciation for what that property is going to be worth in 5 years. Mm-hmm. So you would have spent over a 5-year period at MI roughly $6,600 on that purchase. But now that property is worth $50,000 more. Not to mention, you've been paying down on the principal every month as well, so you're building in equity both ways by paying down your principal and equity appreciation. So when you subtract out just a simple math of, hey, I paid $6,600 from my equity gain of $50,000, you've netted $43,000, a little over $43,000 to your net wealth. So in situations like this, if you're thinking and you need to stay on the sideline because you don't want to pay mortgage insurance or you don't have 20% down, you're missing the game.
I agree.
You're missing out on free money, free equity, free ownership.